Building wealth is a battle between competing philosophies. On one side, index fund purists preach long-term patience. On the other, real estate gurus promise immediate, flashy cash flow. We are cutting through the confusion today by ranking 7 investment strategies from absolute worst to best based on their actual performance. Success in this game depends on one specific trade-off: the balance between passive ease and active control. This matrix maps that exact relationship. We will evaluate each strategy based on its required capital, time commitment, and the specific skill set needed to survive. High returns are rarely the result of a magic bullet. They come from matching your personal resources to a strategy and discarding the myths that waste your capital. Strategy number 7 is stock picking. This involves buying individual shares in a single company, like Nvidia or Amazon, because you believe that specific business will beat the market. Success here requires a fundamental edge. You need to know something the market doesn't, whether that is a deep understanding of operations or the ability to accurately forecast a balance sheet years into the future. Without that advantage, stock picking is essentially guessing. This pie chart illustrates the difficulty of that game. In 2025, 79% of active large-cap U.S. stock funds did worse than the S&P 500. When professional fund managers struggle to beat the index, the logic is simple. Sell before a crash, hold onto your cash, and buy back in when the market hits the absolute bottom. In practice, this strategy is mathematically devastating. Between 1996 and 2025, missing the 10 best market days cut total returns in half. Missing the 30 best days reduced returns by 84%. This chart highlights the trap. 76% of the market's best days occurred during bear markets or the first 2 months of a recovery. The days people fear the most are often right next to the days they need to be invested for. Because these strategies rely on statistically improbable timing and an information edge most people don't have, they act as high-effort gambling rather than reliable investing. Strategy number 5 is dividend investing. Instead of watching numbers fluctuate on a screen, you receive cash payments directly from the companies you own. Dividends are a major driver of wealth. According to Hartford funds, dividends accounted for 34% of the S&P 500's total return from 1973 to 2024, with price growth providing the other 66%. However, dividends require significant capital to be meaningful. A $10,000 portfolio with a healthy 4% yield only generates $400 a year. Be wary of the yield trap. A double-digit yield often indicates a company in distress, where a falling stock price makes the payout look high right before the company cuts it. We are now reaching the strategies that start building serious, life-changing wealth. If you want to master your capital with an actual edge, subscribe to the Money Formula. Join a community of investors who prioritize real education over market noise. Hit the like button and let's finish the list. While dividends provide psychological safety and income discipline, the underlying quality of the business is always more important than the size of the check. Strategy number 4 is dollar-cost averaging into broad index funds. You invest a set amount on a strict schedule, buying when the market is up, down, or flat. This area chart shows the power of that consistency. According to Vanguard, U.S. stocks returned an average of 10.1% annually over the last 30 years. Automating your habit removes emotion and lets time do the work. The downside is that your portfolio will drop with the rest of the market during a crash. There is no excitement here, only the steady rhythm of a long-term plan. Number 3 is value investing. This is the practice of purchasing assets for strictly less than their fundamental worth. These deals generally come from 2 sources: better information or better liquidity. You either see potential in an industry that others are missing, or you have the cash to close a deal quickly when a seller is under pressure. You must avoid the value trap. A stock or property might be cheap because the underlying asset is dying or the foundation is crumbling. Dollar-cost averaging guarantees an average return by removing emotion, while value investing builds a safety cushion by exploiting market fear and pressure. Coming in at number 2 is asset allocation. This moves the focus from picking individual winners to engineering a complete financial machine. In this pie chart, every wedge has a job. Stocks drive growth. Bonds add stability. Cash provides safety and the option to buy during crashes. Real estate brings leverage and income. The trade-off is that added safety caps your maximum upside. You trade the chance of a massive single-stock windfall for a portfolio that survives any economic environment. Serious investors build for durability, focusing on how the entire machine functions rather than chasing the next hot trend. The number one strategy is owner-operator active capital allocation. This means putting your money into assets where your direct decisions control the outcome, like a business you run or a property you renovate. The Federal Reserve's 2022 Survey of Consumer Finances proves the supremacy of this model. This wealth pyramid shows that households in the top 10% own the vast majority of private business equity. These individuals prioritize assets they can physically influence, like raising prices or cutting costs, rather than waiting for the public markets to move. This is the opposite of passive income. It is incredibly demanding and carries extreme risk, requiring years of work to monetize a skill or turn a profit. Public financial advice often emphasizes paths where the individual has the least control, but the data shows generational wealth is built through direct influence. This is the final map. Investing in things you completely control provides the highest potential returns because it demands the most judgment and effort. Wealth creation requires an honest assessment of your resources. Map your capital against this quadrant and start playing a game where you actually hold the leverage.